Should you start buying Nike now or wait for their stock price to drop even lower? Because over the past year, they are down by 33.81%. And so if you invested into the company right now, they might drop by another 10%. But if you don't invest, they might go up by another 10%. So what is the best time to invest into the company? Well, actually, I believe that a turnaround might come in the late summer of 2025. And in fact, the analysts do seem to agree with me somewhat. They do predict the company to hit the bottom in May 2025 and have mid to high double-digit growth in the years to come. Now, to figure out with certainty at which price you should start buying the company at, we will jump to my stock valuation spreadsheet, where we will go through the fundamental 9-pillar analysis and calculate the intrinsic value of the company using our 4 valuation models. Now, first of all, we have to plug in the company's ticker in for all the metrics to update. So we will plug in Nike's ticker, and all the metrics will show up automatically. And if you want to download these spreadsheets, you can do so at the link in the description. Now, first of all, I want to show off the company's dividends. Their current starting dividend yield is sitting at 2.26%, and their trailing free cash flow payout ratio is sitting at only 36.11%. Now, in fact, when I zoom into pillar 8 and scroll down, you can see that over the past 5 years, the payout ratio has been very stable, which is something I very much like. Now, regarding the company's dividend growth, their 5-year dividend CAGR is sitting at 7.23%, which is quite higher than the average stock year-over-year dividend growth. Now, let's also have a look at their dividend yield, which is currently sitting at 2.26%. But what you have to understand is that this is the highest dividend yield Nike has had over the past 10 years. Normally, the dividend yield moves around 0.5 to 1.5%, but currently it is sitting at 2.13%. And this is great mainly for long-term dividend investors, as it really raises your yield on cost into the future. Now, of course, this is a great positive that comes along with buying Nike at their current trading price, but it doesn't tell us whether the company will keep falling in price. And to figure this out, we have to look at the company's financial growth. So over the past 5 years, you can see that the revenue CAGR is sitting at 2.3%, the free cash flow CAGR is sitting at 0.87%, and the net income CAGR is actually sitting in the negative at negative 2.49%. So if I zoom into pillar 4, that is the net income, you can see that it has fallen from 5.7 billion in 2020 to 4.8 billion in 2024. Now, what you have to understand is that even though the net income has been falling, if I zoom into pillar 1, you can see that the PE ratio has actually been decreasing thanks to the earnings per share increasing. So even though the net income has been decreasing, the earnings per share actually increased from $1.6 in 2020 to $3.73 in 2024. So theoretically, Nike's intrinsic value didn't change much at all over the past 4 years, even though they are down by about 60% from their all-time highs. Now, talking about the PE ratio, if I zoom in back to pillar 9, you can see that the 5-year PE ratio is sitting in the red alongside with the 5-year price to free cash flow. But moving back to pillar 1, you can see that currently the PE ratio is sitting at only 21.90, which is well below the 5-year average and in the range we want it to be in. And that is actually the same case with the price to free cash flow, currently sitting at only 16.38, lower than the 5-year average and well in the range we would like it to be in. And this shows us that Nike would be considered undervalued compared to the free cash flow and net income they bring in. Now, something I do want to point out is why the net income has been decreasing. If we direct our attention to the 5-year profit margin, you can see that it is sitting at 11.36. But if I zoom into pillar 6, you can see that over the past 5 years, it has actually been falling, and currently it is sitting at only 9.98. And that is the same case with the return on invested capital, which has fallen from about 20% in 2020 to only 14% in 2024. And so with the profit margin and return on invested capital falling, the company spends more money to make less money, which decreases the net income. But how come the earnings per share have been increasing? Well, the reason for that is the decreasing shares outstanding. Nike over the past 5 years has on average been buying back shares at a rate of 1.27% yearly. And of course, when there are less shares outstanding, there is more net income to split between those shares, and therefore the EPS is higher. Now, before calculating the intrinsic value of Nike, let's have a look at one last metric, and that is the long-term liabilities over the 5-year free cash flow negative dividends, which is sitting at only 0.54. And in fact, when we zoom into pillar 9, something I really like is that Nike on average over the past 5 years has been lowering their total liabilities at a rate of 3.55%. So the company doesn't have much debt at all. Okay, but now that we have gone through the 9-pillar analysis, let's finally calculate the company's intrinsic value. So jumping to the Grams formula revised, I will plug in the high EPS growth into the future at 15%, medium at 13%, and low at 11%. I will then average this out with the analyst predictions and get an average 5-year earnings per share growth estimate of 11.38%. I will then take all these 6 values and get an intrinsic value of $69.60 after plugging them into the Grams formula. Now you can see that this intrinsic value is actually 2% lower than the current trading price. But let's move to the discounted cash flow model, where we plug in the free cash flow over the past 5 years and calculate a very low average growth rate. Now into the future, I will predict the high growth at 7%, medium at 6%, and low at 4%, and get an average of 5.7, which I will use to calculate the future free cash flow. And then using a discount rate of 8.37%, I will discount that cash flow. I will sum all of it up, add cash and cash equivalents, and subtract the low debt of Nike to get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $93.61, quite higher than the current trading price. Now, in the multiples valuation, I want to compare Nike to 3 of its competitors. I will take these competitors' stock prices, divide by their EPS, and get their PE ratios, which I will average out and multiply by the current EPS of Nike to get an intrinsic value of $103.34, again higher than the current trading price. And finally, moving to the dividend discount model, we will take the dividend growth rate of Nike over the past 5 years and average it out to 9%. Now into the future, as I do like to be conservative, I will project a growth rate of 6.67% and get an intrinsic value of $100.12. And so now that we have gone through all the 4 valuation models, we can jump to the ultimate valuation, where we will average them out and get an ultimate intrinsic value of $91.67, which is actually almost 30% higher than the current trading price. And with a margin of safety of 25%, we would get an acceptable buy price of $68.75. Now, as I said at the start of the video, I do believe that Nike will hit the bottom in the summer of 2025. So then when the company is trading below $68.75, I think that it would be a great value buy. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.